Three, two, one, and hello, everybody. Central banking again. In this one, which is a bit of a continuation from yesterday, we're going to bump into what Mystic Mind is worried about. And Mystic Mind has not really been worried over the last 5 years. So, and in this one, there's certainly one article I'm going to read the entirety of, which I don't think I should do copyright-wise. So I'm going to just put up the first take from it, and then it'll be blank afterwards, and you just have to listen to me doing it. I'm sure it'll be all right in the copyright sort of way, but I just want to play safe. So let's start with the money illusion. And this is the plug. I mean, hopefully what I've been saying, you're really plugged in that central banks are a huge part of this. We've got governments, central banks, and the banking system all intertwangled. And there are times like now where I think it's the central bank aspect of that which is the most crucial to be understanding quite what they're up to, because the banking system and the governments are really subservient or not as important as what's happening in the central banks. So, money illusion. The House GOP calls for turning macroeconomic policy over to a cabal of unelected bankers with instructions to ignore the jobless. This is to give you another idea, another way that the government, who are feeling themselves unempowered, this is the United States government, might be trying to claw back, or quite what they're doing, I don't know, because it's the Republicans, and as far as I can see, they're as mad as rabid dogs. Every time Romney opens his mouth, he seems to drive even more of those less well-educated, populist, culturally conservative Republicans into Santorum camp. How can the GOP win those voters back in the fall? The House Republicans have concocted a brilliant idea. I think there's a great amount of sarcasm wrapped around that brilliant idea. The bill, which will be formally introduced later this week by Congressman Brady, would eliminate the employment leg of the dual mandate for the central bank, requiring the Federal Reserve to focus only on price stability. The legislation would also restructure the Federal Open Market Committee. The bill would give permanent seats on the committee to the 12 regional Fed Reserve Bank presidents, which seems a sensible thing to do, who are chosen by regional Federal Reserve Bank directors. Fine. Those boards are composed of private citizens, which is the bit I didn't know about or understand. But this is just to give you another in, because I'm going to go on about central banking again. Mark Thomas, who I follow on Twitter, has written this article, The Fed's Latest Plan to Boost the Economy, and it's directly talking about what I was talking about yesterday. So it's in Money Watch. The economy is recovering and the Fed has policy on hold for the moment. But if further action is needed in coming months, the central bank is discussing what to do. The most likely course of action is a new bond purchase similar to the Operation Twist policy that was launched in September and ends this coming June. So far so good. One thing that is clear from the latest discussion is that some members of the Fed are very worried about inflation. This is evident in the design of the bond purchase plan, which mimics a key feature of the Fed's $400 billion Operation Twist policy. Under Operation Twist, the Fed essentially removes long-term securities, 30-year bonds, let's say, from the private sector and replaces them with short-term securities of equal value, bills up to a year or something like that. Thus, this operation does not change the money supply and hence does not change inflationary pressure, but it affects people's minds, because a lot of people, obviously including the people on the FOMC committee, do not understand that last line. They don't understand basically what they're doing, which is a worry, but it's only to be expected. So here I'm going to carry on reading, but I probably won't put the clip up. There are two ways this can help the economy. First, if the Fed accepts risky long-term assets, risky because it's out for 30 years long-term, in exchange for lower risk assets such as T-bills, the amount of risk held in the private sector falls. The reduction in private sector risk hopefully makes individuals and businesses more confident and hence more willing to spend and invest. But the main effects come through a second channel, the impact on long-term interest rates. So we've got the effect that people out there won't be holding maybe dodgy long-term paper. They've only got short-term paper, and they know they can just keep their eye on things, and if things go wrong they can shop it in for cash. So they're not worried because their short-term paper is just about the equivalent of cash. But the main effect comes through a second channel, the impact on long-term interest rates. The reduction in the supply of long-term assets, because they're bought by the Fed, in the private sector puts downward pressure on long-term interest rates, and although there isn't much room for long-term rates to fall, any reduction could spur new spending and help the economy. So that's the plan. Obviously, the main plan, by buying up the long paper, it drives up the price of the long paper and the interest rate on the long paper down, and that should help businesses because then they should get cheaper loans from banks. The trouble is there that the banks will be making a huge loss, lot less money, because their margin that they're buying and selling their money at is reduced, which is a huge problem that's starting to worry me, mixed in with something else. The difference between Operation Twist and what the Fed is discussing now, that we were discussing yesterday, a policy known as sterilization, is a bit technical, but the essence is easy to grasp. Under Operation Twist, the Fed sells short-term assets off its balance sheet and then uses the cash it raises from the sale to buy longer-term assets. We've got that. Under the present proposal, the Fed would borrow the money from the private sector. This is the new plan. Borrow the money from the private sector in what is known as a reverse repo, and then use the money it borrows to purchase long-term assets. So instead of selling the short-term assets for money and using that money to buy long-term assets, it repos, borrows to purchase long-term assets from money from the public. The loans from the private sector are short-term, and the Fed continues to roll them over until the longer-term assets mature, or it can sell the long-term assets back to the private sector before they mature. So hopefully you've followed the link at the bottom and you're keeping up with this. Notice that once again the money supply doesn't change, and hence the inflation risk is avoided. Now, I bet I can't explain it better than that. So most of you won't have understood now what was said there. So the only thing to do is read it over and over and over again, and I'll read to the end of this article, and that will help as well. And I think here we're going to bump into what worries me. Why do it this way instead of simply repeating Operation Twist? The main reason is that the Fed is running out of short-term securities. It doesn't have enough left to do another round. The sterilization program avoids this problem by creating a different type of short-term asset, a short-term loan, Instead, which is paper, a loan is paper, excuse me. Instead of selling a piece of paper to the public labelled bond, as in Operation Twist, the Fed gives the public a piece of paper that is an IOU, a loan, and those loans can be made in practically unlimited amounts by the central bank. The essence of all this complication is to avoid inflation risk, but it's not at all clear that the Fed should be concerned about inflation at this time. In fact, Fed Chairman Ben Bernanke has stressed he does not think there is much risk at all. A temporary increase in inflation, with an emphasis on the temporary part, could spur firms to increase consumption and investment, precisely what we need to spur a recovery, so say some. One contingent on the Fed, the dovish contingent, agrees with this and would like to see more aggressive action. However, another contingent, the inflation hawks, are very concerned about inflation risk from the policies that have already happened. The new policy under discussion at the Fed is an attempt to lean towards the dovish side to do something to help the economy without causing the inflation hawks to block the action. Nevertheless, it is very unlikely the Fed will take further action unless the economy stalls out or reverses course or deflation fears re-emerge. Now, I think working backwards there, deflation fears will re-emerge. The economy will either stall out or reverse course. Blah is just not good enough. It's blah plus at the moment, but I think it'll soon fall back towards blah. Now, actually, my worry hasn't been brought out in this article. It must be in a later one. So what we've got is a repo which is going to be, there's money out there. Now, this is going to be money market mutual funds. They are going to put the money into the Fed and get a piece of paper in return. That is taking money out of what we'll call the real economy and putting it in the Fed. The money, the cash, goes to the Fed. That's meant to be damping down an inflation risk. But the money market mutual funds take in return a piece of paper which isn't labelled bond, it's labelled IOU. But it's effectively all the same stuff, because what we have in the world is cash, and short-term paper is effectively the same stuff. Right, I'll move on. So, Ming Zeng, sterilised twist could boost money markets, Goldman Sachs. Now this is the bit that worries me. Goldman Sachs now expects sterilised twists to be the Fed's next move in the coming months. So we know all about it now, because that's what they're referring to, what I've just been talking about. Because it sounds weird, doesn't it? You read that opening, Goldman Sachs, and then your mind goes, oh, the bastards and all that, and you can't concentrate enough to go to, now expects sterilised twist. And, you know, who's meant to understand what sterilised twist means? But now we do. And Goldman think it's going to be the Fed's next move in the coming months. And I do too, because it's the economy just isn't good enough. Zach Pandel, Goldman's economist, argues the Fed will see the benefits outweighing the costs. I'm sure they will. He acknowledges sterilised QE may raise short-term interest rates and therefore tighten financial conditions modestly relative to an unsterilised expansion of the balance sheet. I can't disagree with Goldman, obviously, but we're talking fractions, so it's not worth talking about. But Pandel also sees the bright side, arguing that sterilised QE may improve the functioning of money markets by allowing a broader set of financial institutions to be counterparties to the Fed's balance sheet expansion, which is in contrast to QE1 and QE2. How am I going to have time? Most of this crisis in 2008 was caused by this sort of stuff. Money market mutual funds have trillions of money, and they want to keep it safe. They must keep it safe. So what they were doing overnight loans to banks and hedge funds, or banks that lent to hedge funds. This trillions of money that they had, because they knew it was safe because it was overnight. But the banks only had that funding, and hedge funds only had that funding overnight. So when things went wrong, that trillions of money market mutual fund money just said, well, we used to do it overnight. Now we do not. We want to keep our money safe. And that's what they were doing all the time. And then because there was trillions based on this system, the whole thing went glug. And it really hasn't unglugged itself properly yet. And the money market mutual funds are still scrabbling around for safe places to put those trillions. And that's why they're going into government bonds, because that's about the only choice that they've got. So, where were we? Here are the pros and cons of Pandel points out. For instance, many investors and the broader public seem to view sterilised QE more favourably than unsterilised. Now, I'm running... Can I plug the charger in and keep everything going? I've got enough card room, but I'm running out of battery. Oop. Okay. As long as that worked, which it looks like it had, there's no stopping me. So, unfortunately for you, I might be going on a bit again. So, start again. For instance, many investors and the broader public seem to view sterilised QE more favourably than unsterilised QE. That is a sentence that's so easy to pass over, but it's crucially important. What he's saying here is many investors and the broader public seem to view sterilised QE more favourably than unsterilised. But what we've just read before is that there's sod all difference. There really isn't any difference. It's this much difference. But psychologically, these money manipulator people have to take into account the stupidity of most of the world. That's what he's saying here. There is no difference, but we have to plan for them being stupid. And the rest of the investment world being stupid and not understanding what's going on. And the the Fed not understanding what's going on. Yeah? These people have got to plan not just for what actually is, but what other people think it is, although it isn't. I'll give you one more time, because it's a stupid but crucial little sentence. For instance, many investors and the broader public seem to view sterilised QE more favourably than unsterilised QE, even though we believe the distinction should be considered nearly irrelevant from a macroeconomic perspective. If a subset of the population holds these beliefs, wrongly or not, unsterilised QE could affect inflation expectations and possibly commodity prices beyond its impact on the growth outlook. Sterilising may therefore be a low-cost way to avoid or at least hedge against possible negative side effects of further easing action. Additionally, sterilised QE may improve the functioning of the money markets by allowing a broader set of financial institutions to be counterparties to the Fed's balance sheet expansion. It's a repeat. Under QE1 and QE2, with asset purchases financed through reserve creation, only banks could lend to the Fed to finance its purchases. We won't go into that, we haven't time. Other money market investors, such as money market mutual funds, are forced to compete for a smaller pool of assets, which has driven down short-term yields to very low levels. Again, that's a repeat of what I said earlier, but so I'll repeat it. Other money market investors, such as money market mutual funds, are forced to compete for a smaller pool of assets, which has driven down shorter-term yields to very low levels. Money market mutual funds have still got these trillions. They've put them in short-term bonds at the moment, bills. The thing that worries... let's get to the end. The broad takeaway, sterilised QE would provide more risk-free short-term assets to this broader investor base, helping normalise money market rates, Pandel says. Now, what worries me is that increasingly, not just are the central banks becoming more and more crucial to the economy, they are taking over banking functions such as the money market mutual funds overnight funding to banks and hedge funds. what this is doing, it's making the central bank, in a way we talk about the central bank being just the bank's central bank. It's a bank. We know that the central bank is a bank, but it's now acting like a bank and doing transactions like a bank, but not just a few of them. It is doing it's waves of it, trillions coming in and going out. But what that means is every transaction that the Fed does or a central bank does, that's a transaction that a normal bank is not doing. And if the normal bank is not doing it, it's not getting its cut off it. The banks are being squeezed all way round. Now, you might say, oh, well, that's bloody marvellous, because they're bastards. But they are an essential part of the economy that has built up over hundreds of years. They're plugged in to a way that the system works. This means now that the system is going to work in a completely different way. Bankers are going to be made redundant and maybe go to work for the Fed, but there isn't extra profits for the banks. They're being squeezed on their normal lending and on their funny money manipulations. And that worries me, because what will happen is the banks will say, look, our balance sheets are never recovering, and we are now going to have to crank up the interest rates that we charge to businesses and households, or we go under. We just can't. It's either that, or we need a flood of money to make our balance sheet asset side look decent enough, or we're just out of business. And it's not that the Fed doesn't know that, but the Fed is being forced to take these functions over because the rest of the world still is stuck 4 or 5 years later. So the Fed is now doing it. It's doing its macro thing, but I'm not sure if it really realizes that when it takes the work away from the banks, how much the banks are going to be hit by this. And we know what trouble the banks are in now, and this is just taking more work away from them. They're going to be even more shocking state. Right, I'll try and move on quickly. This is just a chart of monetary base and monetary supply. So the dotted line is the monetary base, Eurozone pink, blue's US, and green is the UK. You can see the monetary bases are flying up in the air all over the place. These are the reserves at the central bank. Down at the bottom, you can see the actual money supply in red, solid red, blue, and green, basically just crawling along the bottom. The US has gone up slightly, but they're crawling along the bottom. Standard policy would say that increase the monetary base and the monetary supply will increase after a lag. It isn't. Of course it isn't. And we've been saying for 4 or 5 years it won't. Of course it won't. And why? Because we get this one, this is same, 4b. Koo says that liquidity does not translate into increased bank lending, and suggests that this is because we are in a liquidity trap. I like the first part of the analysis, but not the second part. And this is Edward Harrison credit write-downs. And I agree with him. Forget the liquidity trap, but liquidity does not always translate into increased bank lending. So we go on to Koo. Koo is pointing to the money multiplier fallacy that comes from the concept that banks are reserve constrained. Of course, none of this is true. Banks are never reserve constrained in our non-convertible floating exchange rate monetary system. They are capital constrained. Now, we know the difference between reserve requirements and capital requirements, don't we? And we know that they're not reserve constrained, but they might be, and in fact mostly are, capital constrained. It's tricky, but we're learning, aren't we? Theoretically, banks could lend out up to 10 times their reserves if the reserve ratio is 10%. It's hypothetical because okay, it might be in Brazil, but we don't get reserve ratios of 10% in the Western world. Money multiplier loans equals 1 divided by reserve ratio. In reality, however, banks make the loans first and then look to the reserves afterwards. That means some banks are short reserves and must borrow in the interbank market. And it's the interbank market which is the rate that is the interest rate, that's called the interest rate that the central bank manipulates. Maybe it's not easy, but I think we've got most of these bits understood, and all we need to do is link them together. When the entire banking system reaches the reserve limit, this is still hypothetical, the central bank could theoretically create a credit crunch by refusing to increase reserves. That is, they would not buy assets off the banking system and replace them with cash. But then the Fed would not be able to manipulate short-term interest rates. Of course it couldn't, because that's what it does with its swapping assets for cash from the banks. At least that's what it did. The Fed funds rate is dependent on the central bank supplying the required amount of reserves at any given reserve ratio to keep the interest rate at its target. So in practice, central banks always increase the level of reserves desired by the system in order to maintain the interest rate. And that's what they always did. They would see that there was just enough cash out there in the banks, which was really in their belly, it was in the reserves of the central bank. So the banks would swap around overnight money at a certain rate based on the amount of money that was out there, and that certain rate was what the Fed funds rate was. But now, because there's so much money out there, it'd go boom, down to zero before you can say Ben Bernanke. But they don't want it at zero. They want it at 0 to 0.25. So the Fed pays 0.25 on their reserve accounts. Otherwise, that entire the lending, the Fed funds rate would go down to 0. And that's why it's 0 to 0.25. And that's why they pay interest on the money. It's not tricky. Well, it is tricky. Okay, my point is that the money multiplier is a fallacy in a fiat currency credit system, and see that now that we are in balance sheet recession in which credit growth is subdued is due to private sector deleveraging. Richard Koo says QE2 drove speculation, but what about the real economy? The real economy didn't get the money because the real economy didn't demand the money. This balance sheet recession is not really about liquidity traps, agreed, and the zero bound for interest rates, agreed. It's about over-indebted private sectors that have limited increased demand for credit. If and when the demand for credit increases, so too will the money supply. And that chart, the last one we looked at, the spotty coloured lines and the hard green lines, the hard coloured lines, when people start demanding more credit, then it will start going up. But until then, it won't. Is that our final one? Yeah. Consumer credit breakdown in the United States. Student loans in gold. So we're taking those out. Horrible the way that's gone up. Now this is a bit of a confusing chart, but it's too late for me to explain everything to you. But total debt, excluding student loans in red, you can see it's come all the way down to minus 1.5, and now it's about 0. This appears to say that if that red line keeps going up and consumer credit increases into the positive, then the money supply solid lines will start going up to try and meet the monetary base dotted lines. But this is another big decision, and Mystic says that line will not go much above that 0 line. In fact, I wouldn't be surprised if it turns down and goes negative again. But that's what the big Fed's call is. What are these mad public people doing? Are they going to take this money that we're offering them cheap or not? It's on sale price. Come and get it. But they're not coming and getting it in enough en masse to get what the Fed wants. The Fed is just confused about everything at the moment, it seems to me. It's trying to appease people who are stupid. And that is a very dangerous thing to do. And in its appeasement, it is taking on itself huge amounts of responsibilities that were normally taken by the private sector. And it's just like government taking on responsibilities that used to be in the private sector. And what we know about that is when that happens, it's blue murder to ever get those responsibilities back into the private sector. So what we're going to get is a huge increase in the power of central banks, which will just increase and increase, and shrinking banking sector, which it's good to shrink some parts of the banking sector, but unfortunately they are systematically set up, intertwined with the important parts. So the banking sector is going to come under terrible pressure to try and get some profits somewhere. So it's going to sack a lot of people, but then automatically it's going to try and put the screw on businesses and the private borrowers, which is going to drive the economy down, which is going to drive the central banks into trying to do more things, which will be taking more stuff away from the private banking sector. And that's what's worrying me, because it's not as though the Fed wants to do this, it's being forced into absolutely strangling the banking system that it's really meant to be defending. And I can't see how it can stop strangling it. I think it can only continue till it strangles it near to death. But the banks will not go down on their own. They will strangle the population and bring the population down with them. I can't see any other way out. That's quite enough for the weekend. I'll do in writing that I suggest that people watch or go at this in parts. It was a bit heavy. But there we go. It's a heavy world. Bye. Bon weekend.